Good morning, everyone, and welcome to the FARA eWeek 2020. I'm David Gubbay, partner and head of corporate tax here at FARA. We hope that you are looking forward to a week of highly interactive and engaging events with us. And we're thrilled to have you joining us for this second session, which my colleague James Bromley and I will be running on the theme of structuring investment via tax incentives for entrepreneurial businesses and investors. At FARA's, our focus is on acting for private businesses, family businesses, entrepreneurs, and investors. This week is therefore a key part of our year, and we're delighted to have over 2,000 people signed up to our sessions this week. And please take a look at our EW micro website to see more about how we work with entrepreneurs and investors throughout the year. If you haven't done so already, please do sign up to our final session of the week. This will be an hour of cocktails, alcoholic and non-alcoholic, and networking with some fantastic prizes available donated by some of our clients. Just a couple of housekeeping points before we get started. Please keep yourselves on mute just to prevent audio feedback. There will be an opportunity for questions at the end, but during the session, if you would like to, please do use the chat box and submit questions as we go along. Also, just to let you know that this session is going to be recorded so that we can share this with clients and contacts who were not able to attend. And a recording of the session and a summary of our key takeaways will be available on our dedicated microsite. We are here to help you, so if after the session you have any questions, please do get in touch. And again, full details are on our microsite. As I mentioned, in this session, James and I will be looking to guide both investors and entrepreneurs through the key tax incentives, reliefs, and government schemes which facilitate and maximize the value of equity investment in startup and growing businesses. In terms of our contents for today, we will not be looking at the various government-backed loan schemes which have been made available to businesses during the COVID crisis. And indeed, there is a separate session on debt financing being run later in the week. But instead, we will focus on the 5 reliefs set out on the content slide, and which all aim to facilitate primarily equity investment into companies. We won't be mentioning venture capital trusts and social investment relief, but many of the conditions that apply to those two are mirrored in the EIS conditions. But before we get going on the substance of these reliefs, we just wanted to ask you, the audience, how much use, if any, you have made of some of these reliefs. So we have 2 polling questions to start things off. The first one should be coming up now. And what this is asking is whether you have raised or plan to raise finance for your company using Enterprise Investment Scheme or SEED Enterprise Investment Scheme. And if you are an investor who's taken advantage, please also answer those questions. Thanks. So encouraging to see from the poll that some people have indeed used EIS, and one person has used SEIS. So that's encouraging to see that, that seems to be on the radar of people. We're going to ask a second polling question now, which looks at 2 other reliefs, which people may or may not have heard of. This is whether investors relief or business investment relief have been used by anyone investing in your companies. These are reliefs which are probably less well known, although they are very valuable. And relief, it looks like investor relief has been used once, which is interesting to see. But business investment relief focused on non-domicile investors has not been used. Anyway, we'll be looking at those in a bit more detail because they do offer very valuable tax reliefs, albeit they appear not to be very well known by investors. Thanks for that. For many businesses, being able to offer their investors and shareholders a tax-efficient route for their equity investment is a key selling point, and indeed may well be a requirement before people will invest. And whilst the UK tax code does provide various attractive reliefs and incentives, these are not always straightforward to navigate, and it's always advisable to plan for these as early as is commercially possible, so that opportunities are not missed and wrong turns and traps are avoided. I'm going to hand over now to James Bromley, who's going to take a look at business asset disposal relief, previously better known as entrepreneurs relief, and the lesser known but very valuable investors relief.
Thanks, David. So as David said, we thought we'd start off by looking at probably what is the best known, or one of the best known reliefs that we'll be covering today. And that is what was previously known as entrepreneurs relief. As many of you will be aware, I'm sure, we now know it as business asset disposal relief. That was changed by the Chancellor in the most recent budget. Now, it's a change in name. There are also some changes in the terms of the relief, which we'll go through in just a second. But I think it's probably just worth pausing briefly at this stage to sort of wonder what is in the name, why that change of name might have been changed. You'll see that the changes that have been made to the relief, in essence, make it slightly less valuable. And in a sense, that probably is what's flowed from the change in name. It sort of gives the government the political leeway to go for those further restrictions. But before we jump into the terms of the relief itself, as with all these reliefs, we thought we'd start off by looking at a typical case study, the sort of example situation that these reliefs are really targeted at. And for business asset disposal relief, it would be an individual who is starting a new trading business. That individual will be likely a director or an employee of the company and will be actively involved in its day-to-day management and growth. The individual concerned would typically be one of a smaller number of investors, and in this example we've said that's 4 investors who hold the business in equal shares, so 25% each. And this is really a classic case for business asset disposal relief or entrepreneurs relief, as was. We've got someone who is running the business on a day-to-day basis. They'll be looking to hold it for the sort of medium to long term, and they're one of a relatively few number of investor owners. In terms of the relief itself, well, what's it about? Well, it's famous for cutting the rate of tax, but as I say, it's worth just pausing to look at whether the individual concerned is actually suitable for that. And I mentioned that what's really key for business asset disposal relief is the involvement in the day-to-day operations of the business. Importantly, the tax rate, the tax benefit is to reduce the rate of capital gains tax on exit from a maximum rate of 20% to just 10%. But that's worth just pausing here, because whilst that used to be an extremely valuable asset to have because it was available for up to 10 million worth of lifetime gains, the changes that were made most recently in the budget reduced that to just £1 million of lifetime gains. So the maximum tax saving now available because of business asset disposal relief is £100,000. Now, of course, that's not to be sniffed at, but it's not quite so valuable as was the case in the past, where up to £1 million could have been saved. It's worth noting that depending on how the business is held, it is available for businesses held in trust. However, there are certain other conditions that do need to be met where that's the case. And without going into too much detail on those, very broadly, they relate to the beneficiary's relationship to the business. I mentioned the most recent changes that we've had to business asset disposal relief, not least the change in name and that reduction in the maximum limit. I think there are still potential for future changes to be made too, and possibly the change in name does give the government a bit of political leeway to do that. And it's perhaps a bit more, there's perhaps a bit more appetite to change something that's got a fairly a fairly standard name like business asset disposal relief, as opposed to something called entrepreneurs relief, which I think most members of the public would associate as a social good. So my advice generally, I suppose, or our advice generally, would be that to the extent you're dealing with either it's yourself or it's a colleague or client who is looking at this relief and who's potentially eligible for the relief, it's definitely worth getting advice on that and capitalising on it now, I think, rather than assuming it's always going to be available on the same terms for the foreseeable future. So there's a number of conditions that need to be met for entrepreneurs relief, and it's quite detailed. And those conditions really vary depending on whether the business is a company or a sole tradership or partnership, effectively whether it's incorporated or not. For businesses which are companies, the conditions are on the left-hand side. It has to be a trading company. And what that means is that it means the business can't have what's determined as a substantial amount of non-trading activities. Now, in practice, what that looks like is a distinction in tax terms between trading and investment. And investment is typically holding assets for the longer term to make longer term gains. Property investment's a classic example, versus a trading business, which is usually more regularly turning over its products. So entrepreneurs relief is pausing here. Whilst it is available to a full spectrum of businesses, some of the reliefs which David will go on to talk about later are not available to certain sectors. Whilst entrepreneurs relief or business asset disposal relief is available to all sectors, it does require the company to be a trading company, which is a test that's worth looking at quite closely for certain business types, particularly, as I say, in the property sector. There's also additional tests for joint ventures and businesses held in JV structures, which are worth bearing in mind. And importantly, whilst the business can be a new business and still qualify for a business asset disposal relief, the shares do need to have been held for a full 2 years before the exit or sale event. I mentioned the different criteria for unincorporated business, such as sole traderships and partnerships. And again, the conditions are quite different, but the relief is still available for such businesses. The conditions broadly are that the business itself does need to be sold or transferred to another person or entity, and I'll touch on what that might look like a little bit later and some planning opportunities. The business has to have been held and trading for at least 2 years. It can be used on converting to a different business type. So for example, if it's a sole tradership that's being incorporated, and that's a really helpful planning opportunity which is still available. And there are strict rules that can apply for business assets that might be held in an individual's name, but which are used for a business. Again, the relief is still available for those sales in principle, but there's some extra hurdles to jump through. So that's looking at it from the business side of things. From the individual, again, a number of different conditions, which again vary depending on whether the business is a company or not. For incorporated businesses, the requirements are that the individual has to hold at least 5% of the ordinary shares, voting rights, and entitlements to sale proceeds. And importantly, the individual also needs to be an employee, but from a tax point of view, that can include roles such as directors and company secretaries. So they don't necessarily need to be on the payroll in the ordinary sense of the term. The really important thing for entrepreneurs relief is that all those conditions need to be met for at least 2 years before the sale or exit event in question. So it does require planning in advance. Slightly different for sole traderships and partnerships. That requires the individual to transfer all or a self-contained part of the trading business. Again, that must have been carried on for at least 2 years. As I mentioned earlier, it's available in principle even after the business has ceased, but that sale broadly needs to take place within 3 years, and certain other conditions need to be met. And as I said earlier, for cases which are fairly common for sole traderships in particular, where business assets might be held in the individual's name rather than in the business's name, there's other conditions that need to be met with respect to those assets to ensure that their sale can also qualify for the relief. I think the fact that there are quite strict conditions for business asset disposal relief or entrepreneurs relief presents both traps and opportunities. So worth just sort of having those in mind. Firstly, the opportunities, well, I mentioned earlier, quite generous really, but business asset disposal relief is available on incorporating. So you don't necessarily need to have a sale to a third party to benefit from the relief. Nice planning tool here, because for example, if for whatever reason it's helpful to bring this taxable event again forward and claim the relief now, for example, if clients consider that there's going to be changes that might restrict the availability of the relief in the future, it is possible to in essence trigger the relief in certain cases early. The one caveat with that, or rather two caveats with that, are that there are certain restrictions, for example, on the value that can be placed on goodwill on incorporating. And there are also some sort of slightly retrospective anti-avoidance rules that can prevent disposals that effectively don't ultimately change the ownership of the business, but definitely worth considering because these are opportunities that still exist. Another tool that we see used quite frequently is for entrepreneurs who may be either approaching or have exceeded their new lifetime limit, and given that reduction in the limit to £1 million, that is of course becoming more and more common. It's possible to share the relief effectively to maximise the benefits of the relief between themselves and their family members, for instance, possibly by introducing a spouse or children or other close relatives as investors into the business. Now, provided those other family members meet the minimum 5% conditions that we went through on the previous slide, and they hold an employment role for tax purposes in the business, which, as I say, could simply be a company secretary, for example, it is possible for those family members to potentially qualify for the relief too. So there are planning opportunities there as well. Finally, this is both possibly an opportunity and a trap. It's certainly possible to sort of receive the benefit of business asset disposal relief for sales where you're not necessarily just receiving cash up front. The payment might be possibly received in installments or by way of shares or loans from the buyer. And it is possible to claim business asset disposal relief or entrepreneur's relief in those cases. The problem, or the potential problem, is that you need to be very careful with that. Those sales can be more tricky and the conditions can be much more difficult to apply to all parts of the sales proceeds in that case. We see that particularly with what we call earnouts and other variable sale proceeds, and that's effectively where, for example, the amount of sales proceeds that's received by a seller might depend on the future performance of the business and turnover, for example, over the next few years. Those do present further difficulties with business asset disposal relief, just ensuring we can really maximise the full value of the relief in those cases. So worth keeping an eye out for that and planning ahead. As I mentioned earlier, it's always worth bearing in mind here that whilst there are no sort of whole sectors that are precluded from benefiting from business asset disposal relief, there are certain business types that are just inherently less suitable in many cases. Relatively small scale real estate businesses are a common example where I mentioned earlier that trading requirement. Often real estate businesses will hold assets as investments for the longer term, which can present some difficulties with business asset disposal relief. I think in summary, just before moving on to the next relief, it's worth bearing in mind business asset disposal relief because whilst the value of the relief has been somewhat withdrawn by Parliament most recently, it's still an incredibly valuable relief. £100,000 tax saving is certainly well worth having. And worth bearing in mind in all cases, I think, where you're dealing with owner investors who are involved in the day-to-day operation management of the business, who are effectively able to meet the conditions that we just went through. But turning to the next relief that we'll cover, this is investors' relief. Investors' relief is better suited for individuals and investors who are less involved or really not involved in the day-to-day operation of the business itself. If we look at a typical case study for this relief, it would be usually somebody who's acting effectively as a business angel, a sort of a stood-back investor. That individual might be happy to invest in the business and perhaps provide some unpaid advice, maybe as a non-executive director, but otherwise they don't need to be playing a hands-on role in the day-to-day management and operation of the business. As I say, investors' relief can therefore, I think, be contrasted with entrepreneurs' relief or business asset disposal relief, because whilst the latter is more suited for individuals who are involved in the day-to-day management and operation of the business, investors' relief actually relies on the opposite. It relies on the individual not being involved in the running of the business. That said, it does effectively the same thing as business asset disposal relief. It reduces the CGT rate on an exit event to just 10%. And really helpfully, and we touched on earlier the fact that investors' relief isn't used as often as it perhaps might be, but hopefully some room for growth here, because investors' relief does still apply to the first £10 million of lifetime gains that are made. So not only is that more generous than the now reduced £1 million limit for business asset disposal relief, it's also an entirely separate pool. So take, for example, an entrepreneur or an investor who has used up their full £1 million lifetime business asset disposal relief or entrepreneur's relief allowance. Well, they still have access to the full £10 million allowance of investors' relief. So if you can structure the investment so that it's suitable for this relief instead of business asset disposal relief, this is well worth bearing in mind and has real value to add to investors and entrepreneurs in that sort of situation. I mentioned earlier, the really key distinction between investors relief and ER, entrepreneurs relief as was, is that here neither the individual nor anyone connected to them for tax purposes, and broadly that's relatives and direct family members, is allowed to be an employee of the business. So it does really require that sort of hands-off investment. Also worth remembering that the relief here does require the business in question to be a company. It's not available for sole traderships and partnerships like business asset disposal relief is. And again, just to recap, as mentioned, I think it's worth bearing this in mind now that we do have these further restrictions on what was entrepreneurs relief, because this relief does provide effectively the same benefits to investors. It just has slightly different conditions and requires a fresh approach to structuring. But for investors who may have previously been relying on getting their full £10 million of lifetime gains within entrepreneurs relief, it's well worth considering at an early stage, and again, ideally before an exit event and well before that, whether their investment in the business can be restructured now to benefit from investors relief instead. Because like I say, this does provide effectively the same benefit as entrepreneurs relief, but with a much more generous limit. So I think with that, I'll pass on back over to David, who I think is going to talk about EIS relief and CDIS schemes.
Thanks, James. Yes, I'm now going to take a look at the Enterprise Investment Scheme and its little sister, the Seed Enterprise Investment Scheme. In the case study we have here, we have an individual who is looking to invest in higher risk private businesses. He doesn't intend to play any active part in the business, doesn't want to be an employee or a paid director, and is happy to put his capital at risk. He also expects to have a significant income tax bill during this tax year. And he's also recently realized a capital gain on another investment, and he's happy to reinvest the proceeds of that realization in these private businesses. So he will therefore wish to ensure that his investments qualify for the following tax reliefs provided under the EIS. One of the major reliefs available is that EIS investors can deduct an amount equal to 30% of the invested amount from their total income tax liability, up to an annual investment limit of £1 million. But for investment in so-called knowledge intensive companies, there's an additional £1 million that you can invest. So you can reduce your income tax bill by up to £300,000 each year, or even up to £600,000 in certain cases. And the tax relief can be carried back to the previous tax year. I've mentioned the special investment limit for knowledge intensive companies, and these come up quite a bit within the EIS provisions. And just to mention briefly, these are companies which firstly spend at least 15% of their operating costs on research and development or innovation expenditure. And secondly, either they are creating IP that they propose to use for the main part of their trade, or they have a skilled workforce engaged in R&D work. Just to note that for the income tax relief to apply, the shares must be retained for at least 3 years, and value other than dividends and certain other limited payments must not be received back from the company by the investor, otherwise the income tax relief will be clawed back in whole or in part. The second major relief is that capital gains tax made on the sale of the shares that qualify for income tax relief are exempt from tax. So James talked about investor relief, which gets your tax down to 10%. But if you can qualify for EIS, the CGT relief is obviously better, because this is one of the rare cases in which your capital gains are totally exempt, and there's no limit on the amount of capital gain that is exempt if your shares have qualified under the EIS. Again, various conditions to be satisfied, and the shares must be held for at least 3 years. Furthermore, I mean, if it ends up that you make a loss on the investment, and these are higher risk investments, then further relief is given either against income tax or against capital gains tax for you. And finally, to mention, the last relief that our individual is looking for is to do with the capital gains that he has realized on the other investment. And if he makes a qualifying EIS investment equal to the gain realized on the other investment in the period of 1 year before or 3 years after he sold the other investment, then the capital gains tax otherwise due on the sale of that other investment can be deferred and will only come into charge if and when he sells the EIS company shares. And tax deferred in many ways is tax saved. So very, very valuable tax reliefs if you can comply. So what are the conditions that need to be satisfied for EIS to apply? Well, there are a host of very detailed and quite strict conditions that must be met, and quite a detailed application process must be followed once the investment has been made. And these conditions need to be met when the EIS shares are issued, and generally for 3 years thereafter. We don't have time to look at all the conditions, you'll be relieved to know, but I just want to take you through some of the key conditions. The first one, and this sort of goes to the heart of EIS, is the risk to capital condition, which requires that at the time the investment is made, the company is a genuine entrepreneurial business with an objective to grow, and that there is a significant risk of loss of the capital invested. And this reflects the fact that EIS is targeted at growth investment, and it's obviously a question of fact. In the vast majority of cases, this will not be an issue. In addition, you need to show that the shares are being issued in order to raise money for the qualifying business of the company and to promote its business growth and development. So you can't raise the money to pay off loans or indeed to buy other companies or buy existing businesses. And linked to this condition is one that at the time of issue, the company must not be in financial difficulty. Broadly, it's not likely to go into insolvency or liquidation in the foreseeable future. The company or group must have fewer than 250 full-time employees, or it's 500 employees for knowledge-intensive companies. And it's aimed at smaller companies. So the company or group must not have more than 15 million of gross assets before and 16 million of gross assets after the EIS investment is made. So you sometimes get situations where non-EIS investors are coming into the company as part of the same funding round, and that could cause the gross asset test to be breached. In those cases, it's usually possible to structure the investment into stages with the EIS investors coming in first to ensure that the gross assets test is met at that stage. The company must be independent. This means that it cannot be controlled by another company. And this sometimes needs to be looked at quite carefully in cases where, say, a venture capital fund holds a stake in the company. And the company must also control all of its subsidiaries. So minority investments in other companies can be a problem. And also the company must be unquoted, although for this purpose an AIM listing is fine. Some further conditions that need to be satisfied. The relief is targeted at relatively young companies. So the business must have been trading for less than 7 years or 10 years for knowledge intensive companies, although there are some limited exceptions here. And there's also a limit on how much cash a company can raise, which benefits from EIS relief and the other venture capital reliefs. So the normal annual limit is £5 million, although for knowledge intensive companies, it's £10 million. And there's now a lifetime limit of £12 million of funding that you can raise from EIS and other venture capital reliefs. A very important condition, a little bit similar to the investor relief condition, is that the EIS investor must not be connected with the company. And connection here can arise in various ways and also takes into account the persons who are closely related to the investor. So in particular, the investor cannot own more than 30% of the company's ordinary share capital and mustn't otherwise be able to control the company. So you're looking for independent people in effect. Furthermore, the investor must not be an employee of the company and generally mustn't be a director of the company. But there are some exceptions here. I mean, you can be an unpaid director, effectively a non-exec, just getting reasonable expenses reimbursed and certain other payments. And in limited cases, you can in fact be a paid director, provided you haven't previously been involved with the company or its business and certain other conditions are met. A key condition is that the business of the company or the group needs to qualify, and it needs to be a trading company as opposed to an investment company. Unlike business asset disposal relief, not all trades qualify. Most trades will qualify, but certain trades are specifically excluded, being those which are perceived generally to be low risk. So the excluded trades include things like property development and dealing, farming, hotels and nursing homes, some financial services activities, certain IP licensing and some others. And sometimes it's really not always clear if a particular trade is disqualified or not. I mean, for example, we've had to look quite carefully recently at certain financial services type businesses to work out if they qualify. And in cases of doubt, one can apply to HMRC for an advance clearance on the point. But note that a company can have a certain level of non-qualifying trade or investment activity and not be disqualified. And this can generally be no more than 20% of its overall business though. Finally, do note that the EIS shares must be new ordinary shares which are subscribed for fully in cash by the investor. So EIS relief doesn't apply to a transfer of existing shares, a purchase of shares from somebody else, and nor can you convert a loan into an EIS qualifying investment. In addition, note that the EIS shares cannot have certain preferential rights over other share classes in the company, and in particular, they mustn't have certain dividend preference rights and mustn't carry a preferential right to assets on a winding up. And this latter requirement in particular has caused problems for companies in recent years who have had growth share classes. The growth share class is typically a class of shares which benefits only from part of a company's capital proceeds. And the existence of those growth shares have meant that for some companies, that's caused their EIS share class to have a preferential right to assets on a winding up because they rank above the growth share classes. And there have been a number of recent tax cases on this point. But I would say with careful drafting of the company's articles, it is possible to have a growth share class and still have the ordinary share classes qualify for EIS, but some care is needed there. I'm going to turn now to the seed EIS. And in our case example here, we have an investor who is a high net worth individual. She's looking to invest smallish amounts into the highest risk startup businesses. Again, she doesn't plan to play any active part in the businesses and is happy to put her capital at substantial risk. So for her, she's clearly looking at the SEIS reliefs to apply. And SEIS is really aimed at encouraging individuals to make investments in startup trading companies. It offers quite similar tax reliefs to EIS, but has a more generous income tax relief, which reflects the fact that these investments are greater risk. So if our individual here makes a qualifying SEIS investment, then she will benefit from the following reliefs. She can deduct an amount equal to 50% of the invested amount from her total income tax liability in the year, up to an annual investment limit of £100,000. So she could save £50,000, but from tax. Again, like EIS, the shares must be held for 3 years at least, and all the conditions must be satisfied. Any unused annual investment allowance, however, may be carried back and used in the previous year. So you could be investing in effect up to £200,000. Again, like EIS, capital gains made on selling the shares will be completely exempt from tax once you've held the shares for 3 years. You get tax relief again if you happen to make a loss when you sell the investment. And again, you can get reinvestment relief in relation to gains made on other assets in the relevant qualifying period. So very valuable reliefs, but smaller amounts. And just having a quick look at the conditions that apply for SEIS, very similar to EIS, but stricter in some cases. So it's aimed at smaller companies. They can't have more than 25 full-time employees. The company must not have gross assets of more than £200,000 before the SEI investments are made. And the most the company can raise from SEIS in total is £150,000. And the company mustn't previously have applied for EIS or certain other tax incentive schemes. And it's looking at young companies. The business mustn't be more than 2 years old generally. And we sometimes get cases where somebody's putting in, say, more than £100,000 into a growing young company, and they want to get both SEIS and EIS relief on the total sum that's going in. Again, with care, it's normally possible to structure the investment such that the various limits are not breached. And typically, of course, you'd make sure that the SEIS investment goes in first, and thereby satisfying the asset and investment limits then. And then later, potentially the next day, the investor can make their EIS investment into the company, and both reliefs can be claimed in the same tax year. And then finally, on the topic of EIS and SEIS, I wanted just to mention the increasing use of advanced subscription agreements by companies. And these are typically used when companies are between funding rounds, but need some additional cash into the business now. And they may have willing investors who will put the money in, but who want EIS or SEIS relief. For the company, though, commercially, it makes sense for them only to issue the shares when the next funding round happens and at that price. So what we see happening with a number of companies is that these advanced subscription agreements are being entered into, whereby the investor provides the cash to the company now, but it's agreed that the shares will be issued later. It's obviously at the later stage when the shares are issued, which is when the investment is treated as made for EIS purposes. Now, it is possible to draft ASAs in such a way that EIS and SEIS relief will apply, and we've done this on a number of occasions, but care is needed. And the Revenue have been looking at ASAs, recently updated their guidance on these. And they do work, but the Revenue says in their guidance that the company would need to demonstrate how the timing and terms of the ASA fit into the company's business plan and its planned expenditure on growth and development. And the risk is that really the more complex the agreement and the longer the period between the investor entering into the agreement and providing the funds and the time the shares are issued, the less likely it is that the arrangements will satisfy the detailed requirements of the legislation. Just a few points to note on the Revenue guidance. I mean, they take the view that ASAs may not be suitable for EIS and SEIS unless, for instance, the agreement provides that the payment cannot be refunded under any circumstance, cannot be varied, cancelled, or assigned. The sum provided mustn't bear interest. So all of that's really getting at the fact that these sums provided up front mustn't be akin to a loan, because you can't convert a loan into shares and get EIS relief. And then finally, the revenue said that the long stop date between the date of the agreement and the issue of the shares mustn't be more than 6 months. So if, say, your funding round, which you anticipate to happen quite soon, doesn't happen within 6 months, you do need to be prepared to issue your shares to the investors by the 6-month anniversary. I'm going to hand over to James now to take us through the last tax relief, that of business investment relief.
Thank you, David. So this is the last relief we'll cover in the session this morning. And it is, as you'll have probably all gathered from the replies to our questions at the outset, probably not so well known and I think relatively little used. Certainly when this relief was first introduced a number of years ago, I think the uptake was extremely small, certainly not anything like what the government had hoped for. So unusually, particularly given the changes that we spoke about at the outset to entrepreneurs relief, the government has made changes to the conditions for this relief to actually make it more accessible and more usable by investors. So again, definitely worth bearing in mind because there is a real push to get this relief used, certainly from government. So the relief is slightly different from the others that we've covered, the other investment reliefs and schemes that we've covered in this session so far, in that this is really suitable for a quite narrow category of investors, but those who it is suitable for use by will find it extremely useful. So a typical case study here is an individual who's born and doesn't intend to stay in the UK over the longer term. And in tax terms, what that's getting at is that they are what we call non-domiciled in the UK. They have a domicile of origin or choice outside the UK. And by being resident in the UK for tax purposes, but domiciled outside the UK, these individuals are normally eligible to claim what we call the remittance basis of tax. And what that means very broadly is that individuals are not taxed on their non-UK income and gains, except and unless they actually bring those income and gains into the country. So it's a very favourable tax regime. I'm sure lots of you will be aware of the UK's non-dom regime and its popularity. But it does come with this thorn in the side that actually on bringing money into the UK, slightly perversely perhaps from a policy point of view, the individual is taxed and is therefore disincentivised from bringing funds into the UK. So the question really is, and the whole sort of raison d'etre for this relief is, well, what happens if you have such a person, a non-domiciled individual claiming the remittance basis of tax, but they'd actually quite like to invest in a UK business and in essence contribute and enhance the UK economy? Well, it seems slightly odd on the face of things that they're suffering a tax charge in doing so. So that's really what this relief is all about. It's aimed at getting rid of that tax charge on what we call a remittance, i.e. bringing offshore income and gains into the UK. As I said at the outset, it's therefore got a narrow category of persons to whom it applies. It only is really going to be relevant for non-UK domiciled investors. Now, obviously at FARAs we deal, the bulk of our business is international in nature. And so it's something we see quite a lot of, and it's conversations that are well worth having, certainly for the sort of clients that we work with and for businesses that are exploring international investment. As I say, the purpose of the relief is that it enables those individuals, those non-domiciled investors, to bring their funds into the UK and invest them in private companies without incurring the tax charges they would normally expect to have if they brought the funds into the UK for personal use. Now, interestingly, David said at the outset rightly that the schemes and investment reliefs we've looked at in this talk have really been equity focused, and that remains the case. But it is worth bearing in mind that for business investment relief, broad as it is, actually both equity and debt investments qualify for this relief. So whilst that's not been the focus of our talk so far, this does work for debt investments provided relevant conditions are met. The real value, I think, and the power, frankly, of business investment relief is when it's combined with the other tax reliefs that David and I have covered so far. as I say, business investment relief is really about bringing the funds into the UK at the outset. But of course, you can combine this then with some of the reliefs that, for example, David mentioned earlier, take EIS, where you can perhaps benefit on both bringing the funds into the UK tax-free and then enjoying the EIS benefits David went through earlier, including the deduction that's allowed against the UK income tax bill, the potentially capital gains tax-free capital growth in the business, the reinvestment allowances that David mentioned. So it's an extremely powerful tool when used in conjunction, because it enables non-domiciled investors to both make an investment tax-free and potentially realise their gains, either tax-free or low tax, depending on which relief they're going for. And in some cases, for EIS and CDIS, enjoy the other sort of ancillary benefits that are available for those reliefs, such as the income tax allowances that David flagged. So it's really in combination with those other reliefs that this relief really comes into its own. There's a number of conditions that need to be met, although, as I said, these are now a lot less strict, certainly than they used to be, and also an awful lot less strict relative to some of the other schemes of reliefs we've covered, which have really very precise and narrow conditions. At its outset, the main condition here is that the investment in question must be made directly into a UK private company, so not a listed company and not an unincorporated business, such as a partnership or a sole tradership. But beyond that, there are fairly minimal restrictions in terms of what the business does. The only real requirement is that it has to be a trading business, and we've touched on before the distinction between investment and trading from a tax point of view. But provided that's the case, that's really it, frankly, from the business's point of view. None of the detailed conditions that David mentioned for EIS, for instance, as relates to capital being put at risk and the use of the investment proceeds. So the key conditions really for investment relief, for the investor to bear in mind at least, are that the investment has to be made within 45 days of the funds being brought into the UK. So you do have that grace period between bringing the funds in and making the investment without triggering any remittance tax charge. Importantly, and again, this is sort of a similar factor to investors relief and EIS that we flagged earlier, neither the investor nor anyone connected to them, so family members, for instance, can have a connection with the business, and nor can they receive an immediate benefit in connection with making their investment. Now, it seems like a bit of a strange condition on the face of things, because of course one expects to have a benefit from making an investment. That's the purpose of making it. But really what this is getting at is it's a direct benefit. So for instance, having an immediate reward or thank you, or a gift, or something similar to that on actually making the investment itself. So the simple capital growth or dividend payments as the business grows and the investment becomes enhanced is absolutely fine. There's also a 45-day rule that applies once the investment is sold, because there's again a 45-day grace period on selling the investment. And so within that period, the individual investor needs to either withdraw the funds back offshore or invest it in another business investment relief qualifying company in the UK within that 45-day window. I said earlier, the target has to be or can intend to be a trading company or the holding company of a trading group. And that's worth bearing in mind here, because again, the business in question doesn't actively need to be trading at the time the investment is made. Again, a distinction perhaps between EIS that we spoke about earlier. Here, this can be in essence a speculative investment to a business that is at a very early stage, perhaps drawing its business plan together, but expects to be trading within the near future, within the next few years. The only real restriction on this for business investment relief is that the company does have to become operational and trading within 5 years of the investment being made. If it isn't, then the relief is effectively clawed back. But of course, that 5-year period is quite generous, and is one of the things that the government has enhanced in the changes it made to the relief most recently. So I think in sort of summary of business investment relief, it's absolutely worth bearing in mind whenever a business in particular or as an intermediary, you're dealing with a non-domiciled investor, because it is, as we saw from our poll at the outset, I think it still remains underused, although use has certainly increased since it was first introduced and some of these conditions have been relaxed. But it's really a very powerful tool, as we said, when it's used in conjunction and in combination with some of the other reliefs we've touched on now. That might make the whole piece quite complicated, and of course it's worth seeking advice at an early stage to ensure that the investor can really maximise the reliefs in tandem. But it's potentially a really very valuable tool, and I think definitely worth bearing in mind as almost a cherry on top of an investment that's already intended to benefit from the other reliefs that we've covered today. So I think on that, looking at the time, we have a bit of time left. So I'll pass over to David, as I gather we've hopefully got some questions we can answer.
Indeed, great. Thanks, James. Yes, everyone, we're very happy now to take any questions from you. If there's anything you'd like to ask, either via the chat box or in person, if you'd like to raise your hand, then we can put you on screen. So do let us know if you have anything.
Charles, yeah, hello.
Hi, David. Thank you very much. Just quick question about the SEIS funding. It's a sort of a new, I'm really sort of getting into the first company, and I set one up. I incorporated a company with the intention of sort of research and development, but deliberately haven't incorporated under the name of the company, and intend to sort of set up a new one and then sell rights to it, to hopefully still be within the 2-year period, because I don't want to go over the 2-year period for SEIS sort of in planning before then getting to the stage where actually needing investment. Is that a sort of a logical and justified approach, or am I going to get into difficulties if I can't prove that it's an entirely new company with no prior connection to another company?
I think you should be all right. I mean, so are you suggesting the idea is that you would set up a new company to take on the business of the old company, or is the business just still within you yourself?
So the first company is just me, and it's under one name, but I'm working on products that I intend to incorporate under another business name. So the two will to be eventually separate, and I might even start. It's a clothing company, so I might start manufacturing and selling under sort of the pseudonym, but trading as Cult Wax. But ideally want to set up, the company's called Pharaohs, to set up Pharaohs as a separate incorporated company. But the plan would be to then maybe set it up in 2 years down the line, and then be available for SEIS sort of once the ball's rolling. Because otherwise 2 years is actually not that long, at least for me, because it's first company I'm working by myself, and I don't want to miss that window. Is that legal for SEIS?
Yeah, but I think that should work. I mean, I don't think you won't be able to use any of the SEIS money in the second company to buy the business from the first company.
No, yeah, I agree.
You would need to get it into the second company somehow beforehand.
Yeah.
And then I think you could look to unconnected investors to raise funds under SEIS, and then you know, if that's successful, potentially under EIS for further sums.
Exactly, perfect. Okay, so yeah, I guess the main thing was that HMRC wouldn't say this is just the same company under a different name. That's okay.
I think that's okay, yeah.
Brilliant, thank you very much.
I've had a question that's come in via the chat function, I think from Oliver, who has asked if the test of ownership, I think this is in relation to business asset disposal relief, it is all about the actual ownership of the shares or the right to own. He's given an example of an employee who might own less than 5% of the business under an EMI scheme, with those EMI options held for more than 10 years, but won't be exercisable until exit. Oliver, the answer to that question is that ordinarily the tests are based on actual ownership. They're based on sort of a fictitious sale that might have happened at any point within that 2-year window prior to exit. But it's a little bit different for enterprise management incentive options. And just for those who don't know, EMI options are effectively a tax incentivized way for employees to acquire an equity stake in their business. I won't say too much because I know David and my colleague Charlotte are going to be talking about those later in the week, so I'll refer to them. But the answer is that where you have such options, where you have EMI options, the entrepreneur's relief or business asset disposal relief conditions are interpreted more generously. And you don't actually have to establish that 5% ownership throughout the period of the EMI scheme options being granted. So the immediate answer to that question is in a case where an employee owns less than 5% of the business because of their shares under an EMI scheme, the answer is that should still qualify for business asset disposal relief, provided the other sort of more general conditions relating to the business are met.
Excellent, thank you. Sorry, I'm trying to work out how to show my face, but that's perfect answers. I mean, it's not necessarily EMI was my example. It could have been any kind of option scheme, but you've answered it. So thank you.
No problem.
I had a couple of questions coming in. One was whether a non-executive director's shareholding qualifies for entrepreneurs relief, and the answer is yes, potentially yes. If they are a director, then that means they qualify as an employee for entrepreneurs relief purposes. Of course, they'd need to have at least a 5% shareholding and to hold the shares for 2 years, and then they can qualify for the relief. There was also a question about whether there's a practical minimum size for EIS investments, given the costs, I suppose, and the admin time taken up to set up the scheme. I mean, you're right. I mean, in order to ensure that your company is appropriate for EIS, will require some thought and some investment in terms of reviewing all of the conditions for the company, and also entails obviously some application and interaction with HMRC to ensure that all of the formal application conditions are met. I mean, typically, I suppose we wouldn't see EIS being raised for very small amounts, but certainly we have had clients who've had 1 or 2 individuals come in and say that they are only prepared to invest if the company will apply for EIS. And it can still be economic, even if one's only looking at relatively small sums of money. If your business is fairly straightforward, your shareholding is not overly complicated, you don't have a complicated group structure, then the costs are not going to be particularly high. And I think it then does make sense to look to get the tax reliefs for your investors.
David, we've got a couple more questions on the chat function, and conscious of time as to whether you have they're on your side of the things. I'm afraid they're on CDIS and EIS. Yes. If you have time for one more.
Yeah, so there is a question about whether if the company has raised capital before, does that create a problem for EIS or SEIS qualification? Again, it depends on the particular facts. Clearly, if you've raised EIS relief before, then you probably wouldn't be able to get SEIS relief because of the various limits that apply. But companies can raise funding in a series of EIS rounds and still comply, provided they stick within the relevant financing limit. So it is possible, but I think it's one of those where one would have to look quite carefully at the particular facts. I think, as James has mentioned, we probably are at the end of our timing for this session, and James and I would like to thank you all very much for attending. We do hope it has been useful, and if anyone has any follow-up questions that we haven't been able to answer, or anything comes up later, please do contact us via email later, and we're very happy to respond. We do hope that you will all enjoy further Entrepreneurs Week sessions with us throughout the next few days. And thank you all again for attending, and we wish you a good afternoon and the rest of your day.